What's up, guys? This is Dan with I Did It for the Dividend. Today I want to talk about a classic turnaround play. About a year ago, I was watching Mad Money with Jim Cramer. This gentleman calls in from North Carolina and he's like, "Hey, Jim, is Scott's Miracle Grow a buy right now?" Cramer, yep, Scott's has been a buy for a long time. Hangs up the phone. Next caller. And this is back when Scott's was trading at $145 to $155 a share. Fast forward to now, fast forward 1 year, and this stock has been trading in the $41 to $63 range. So Mr. Market is a little bit bipolar, maybe overreacted a little bit. As Benjamin Graham puts it, it's Jekyll and Hyde as far as the market goes. Scott's was definitely overvalued when it was $220 a share, but it becomes much more compelling in the 40s and the $50 range. The starting yield on this thing right now is 4.63%. At the time of the recording of this video, the shares are trading at $57 a piece. To put that into context, the 5-year average starting yield is 2.24%. So we're talking 240 basis points higher on the starting dividend yield. So that's huge. Now, this is a narrow moat company. Most basic materials companies, you're not going to find wide moat companies. So this is not necessarily a core position, but this is rather a turnaround play. And I'm not telling you how to allocate it in your portfolios. I'm not a licensed financial advisor. This is not financial advice. But for me, it's 1.7, 1.8% of the portfolio. And institutional ownership is 70%, and quite a few of the mutual funds that hold this stock allocate similarly, anywhere between 0.7 and 2.2% allocation to this company. Morningstar has a fair value estimate of $115 a share, so it's looking about 50% undervalued. They do, however, have a bear market fair value. Their bear case fair value is about $65 a share. So I usually like a 20 to 30% margin of safety with cyclicals, with basic materials companies, or narrow moat companies. And so in order to get a 30% margin of safety based on that bear market fair value of 65, you'd be looking at an entry point of around $45 a share. So it might be worth putting this stock on your watch list and finding your desired entry point. The balance sheet is ugly, 87 million cash to 2.97 billion in debt. We've got negative free cash flow right now. But I think it's important to remember with a turnaround play, it's supposed to be ugly when you buy it. And then as it gets prettier and prettier and the story becomes more rosy, you can consider selling it and taking gains. And a great example of this was during the pandemic. I was buying oil companies and I was buying real estate investment trusts. Oil companies were not profitable. Even the best quality companies like Chevron, with the lowest production costs, were not profitable because oil was $20, $30 a barrel or even lower at some points. But buying Chevron at $85 a share turned out to be a great investment because I was patient. I waited for it to turn around. I waited for the company to become profitable again. The same story with Shell, ExxonMobil, BP. A couple of those companies cut their dividends, and as they started reinstating and growing their dividends again, the share prices recovered very well. And those were stocks that I took 100% capital gains on. And as far as real estate investment trusts, we had FRT, Essex Property Trust, and Realty Income. I was picking up shares of all three of those companies and did well on those. So there's quite a few of these turnaround plays. You can probably find one or two in every sector. Stanley Black & Decker might be another good example. Maybe that's a stock for another video. And there are companies too that are performing decently, but the share prices are beat down because of the sector they're in. Retail, for example, like Contour Brands or VF Corp. These are great companies with great brands, but they're beaten down. So talking about Scotts Miracle-Gro here, my main ride or die basic materials stock that I own is Air Products and Chemicals. I love the company, but I have a fairly full position, and also the share price has run up about 28% recently. So I'm looking back at a turnaround play like Scotts. I'm looking at this potential upside to fair value. And in my mind, I'm buying this with a 20-year outlook. I'm a big fan of Peter Lynch. He always talks about giving your stocks 20 years, being patient, especially with cyclicals, things in the technology sector. I have the same mindset when I buy Intel. I love the company, but it could take a while for the research and development spending to play out for them, and for us to get back to dividend growth and free cash flow growth. So with Scotts, it's the same deal. I'm looking at this company with a long-term outlook. If in 1 to 3 years I have 100% capital gain, I'll have to consider taking the gains, but I'm not expecting that. I'm holding this thing for at least a decade in my mind. Every time I buy shares, I'm like, okay, I'm going to have these in the portfolio till 2030, and I'll do just fine, I think, with that mindset. So with that being said, I'll finish on one last note. The analysts, there are 8 analysts covering this stock at Yahoo Finance. They've got an average 12-month price target of $57.13, a low target of $45, and a high target of $85. I don't look too much into these analyst estimates, but they are kind of a fun tool to, just take a peek at and see what's going on there. So do your own due diligence. Obviously, do your research. The ex-dividend date is coming up November 25th, so you have time to do some research, look at the numbers for yourself, the cash flow, the balance sheet, understand the fundamentals, and then you'll still have time to pick up shares before the ex date if you want to get that dividend in December. All right, I did it for the dividend. Out. Happy investing.